don't panic. That's always the message when things get a little bit dicey, and there's some things that have been getting a little bit dicey. On Friday, March 10th, 2023, the California Department of Financial Protection and Innovation shut down Silicon Valley Bank, SVB, and appointed the Federal Deposit Insurance Corporation as the receiver. Now look, entering receivership with the FDIC means that the bank has failed and is no longer able to operate on its own. The FDIC takes control of the bank's assets and liabilities and works to resolve the bank's outstanding issues and find a way to return as much money as possible to the depositors and the creditors. This is big news, folks. The reality is we haven't seen a bank fail like this in over a decade. One of the largest institutions lending today, SVB, had billions of dollars on the balance sheet, but with the change of interest rates, some of the debt obligations they purchased with the deposits they had raked in over the years weren't looking so hot. We're not going to get into a whole bunch of different technical stuff about what it means to have your assets marked to market with a given, facing the existential crisis of interest rates going kind of bananas. Here's the deal. The FDIC insures a bank account for $250,000. So if the bank is unable to pay back the depositors when they try to get their money, there's an insurance plan for that. There's something that will protect you. However, if your account is over $250,000, that's a really big problem. That means the FDIC is not able to step in. There are technology companies, so many of them, dependent on SVB. They may not be able to make things like payroll or pay vendors or pay insurance. This could be devastating, and it will be devastating for so many people. At the end of 2022, this bank, SVB, had 37,466 deposit customers, each holding over $250,000 per account. As I said, that threshold is really important to note. That's exactly what it is, what is insured. But what we're finding is that potentially 93% of the deposits in the bank are not going to be able to be insured by the FDIC. This is a significant change. Out of the $173 billion in deposits in the end of 2022, 152 billion with a B, are uninsured. Now, I've represented banks and dealt with cases that involve FDIC receivership. This is a messy process. We are going to learn a lot over the next coming weeks and months, but it's important for you to know that don't panic. Don't panic. It's important to take a breather. All of the things happening. What ends up going on for Silicon Valley Bank is not really they're unable to pay their debts or unable to realize the value of the bonds that they invested in with the deposit money they were receiving. It's a question of what happens if everybody says, I want my money. What happens when every single person says, hey, I want my money back? Modern banking doesn't really allow that, honestly. When banks take on deposit money, they then invest it in different things. They loan it to people. So in some cases, you could have things where you have $1 for every $10 you've loaned out. If everybody comes in and asking for the money, that's a classic bank run. That's exactly what we saw with SVB. People saw the news, people began to worry, people began to ask for their money back. And when you can't get the money back, you have to take a pause and say, hey, we need to shut down the bank. The FDIC becomes appointed the receiver. All of the financial information, all the financial values and assets get transferred to the FDIC to help apportion how people get themselves reimbursed. Assets are sold off. And then ultimately for the people who are not insured by the FDIC, that over $250,000 per account. You can have multiple accounts and they're all insured up to that $250,000 amount. The remainder, the part above the $250,000, that gets apportioned out on a what we call pro rata basis based on priorities of people who get paid. This is really, really interesting. And I hope this video is somewhat helpful in helping you understand what we see in the market today. I'll put some sources, some articles that are really good at kind of explaining the history of the bank and what exactly took place, why these things transpired the way that they did. But the only goal for us right now is to say, I hope there is no further contagion. This is always the worry when you have financial institutions and people losing faith in those institutions.